Welcome back to Trendlines Over Headlines, the show where we break down the markets with some of the best traders and analysts in the world. My name's Patrick Dunawilla. I'm the editor of the Chart Report, and I'll be your host. Joining me today is John Kolovos. John is the Chief Technical Strategist at Macro Risk Advisors. Some of my favorite analysts tell me John is one of the best sell-side technicians in the game right now, so you won't want to miss our conversation. But before we talk to John, it's Friday. The markets are closed, so let's take a quick look at how this week played out. Stocks had their worst week in about 6 months. All four major indices closed lower. The Dow led, but still fell almost 2%. The Russell 2000 lagged, dropping more than 3.5%. Taking a quick look at the S&P 500, it dropped nearly 3%, marking the worst week since March. The uptrend line off the October lows remains intact, but we're testing support at the August 2022 highs around 4,300. If 4,300 fails to hold, there's another major support level just below it at 4,200 that would coincide with the 200-day moving average. Taking a quick look at sector performance, all 11 sectors closed lower on the week by more than 1.5%. Healthcare led, but still fell a little more than 1.5%. Consumer discretionary lagged, dropping more than 6%. Now, the big story this week, you might be sick of hearing it by now, but the big story was the breakout in Treasury yields. The 10-year U.S. Treasury yield continued higher, closing at its highest level since 2007. Meanwhile, the U.S. dollar index rose for the 10th straight week, closing at its highest since November. Anyway, let's see if John can help us make sense of the puzzle. I know we've been trying to do this for a while, and a lot of your peers and our mutual friends speak really highly of your work, so it's an honor to have you on, and we got a lot to cover today, and I know you brought some great charts with you. What a week it's been, right?
Tell me about it. Talk about volatility out of nowhere, in essence. Yeah, and this is, as we're recording this, is the day after the Fed meeting, and the S&P had just had its worst day since March. So, yeah, things are getting interesting.
Yeah, I saw that, right before we hit record. This is, we're recording this on Thursday, so the week isn't quite over, but we're on track for the worst week in the S&P 500 since March. So volatility has definitely come back, and it was getting awfully quiet there. We had so many 1% declines last year, daily declines, and for the last few months, it seemed like they just kind of disappeared, but they're coming back in a big way. But let's kick it off with the S&P 500. What are some of the levels or indicators that you're watching right now?
Yeah, sure. So let's dive right into it. So let's start a discussion, big picture, with regards to the S&P 500. So what I've been explaining and talking to clients about has been this, essentially. The market was going to pull back in July, whether or not you are a long-term bull or bear. So what do I mean by that? So going into July, sentiment was frothy, right? Overly optimistic. A lot of the data that I track was suggesting that momentum was overbought. You had momentum divergences as well. Then you can overlay that with seasonality as well, saying that, hey, the market is at least due for some sort of give back.
And yeah, and it seemed like clockwork too. I mean,
yeah.
You hear about August being a rough month, and the S&P 500 peaked on July 31st. And as soon as we turned the calendar, it was just whoop.
Right. So it's really benign. It should be a benign pullback, right? But then longer term, we still have issues with breadth, right? There really hasn't been great sponsorship beneath the surface. And from a longer term perspective, until the S&P makes a new all-time high and can hold it for more than, a week or two, we can make the argument that the advance since the October low is a cyclical bull within a secular bear. We can't dismiss that. I'm not saying it's high probability yet, but it's something to be aware of. So where the market started to pull back in July was at a good retracement, level of that bull run, where okay, the market was poised to pull back. Now, throw in the fact that markets are very late cycle. Fed inverted the curve so steeply for so long, not good. Small caps not doing anything. European indices faltering and rolling over. The market's very late cycle, and like I said, the market was poised to pull back, whether or not you're a bull or a bear. Now, let's kind of fast forward a little bit to where we are currently. What we have to think about when it comes to any sort of pullback is this a good buy, like BUY, or is it a good buy, like goodbye, like bye-bye, right? And it's really difficult to know, right? It's usually very difficult to know. So you have to lean on trend. And whether or not you want to use something simplistic as a 200-day moving average, right, which is good enough, to be quite frank with you, or you get something a little more systematic and robust, trend models, what have you, they're all still positive for the S&P. So you have to give the market the benefit of the doubt. So what does that mean? It means a pullback should be in 3 stages, right? So classic technical analysis tells you it'll be like an ABC pullback. And the way that I'm interpreting the market, and that's kind of where I'm going with this long and winding road to 4,800 is that we are doing what is a classic ABC pullback, which projects the S&P to on or around the 4260 area. And if you look real close, Patrick, where is that 200-day moving average going to be in a couple of weeks' time? Right around there. So this is a check back to trend, perhaps similar-ish to what we saw in February. So I'm going to treat this for now as something more of a pullback within an ongoing uptrend. But if we start building value underneath the 200-day, start breaking trend, then we'll have to start taking more seriously my earlier comment about this being a secular bear market.
Yeah, I think that's a really, really unique call right there. You said a cyclical bull within a secular bear. Is that right?
Yep. Yeah.
And now, is that call more based on the macro? I mean, like you said, the trend is still intact, right?
Yeah. Well, it has to do with, and we'll get to this in a second, and maybe we'll tease it or we'll pull it up later, which is this. It comes down to the commodity. So yes, it's part macro. And secular bull markets and equities don't usually overlap with secular bull markets and commodities for very long. And I have this chart that goes back to 1900 that shows this, and they alternate. So commodity bull is when equities are in a bear. Equities are in a bull, commodities are in a bear, right? They alternate, right? It's almost perfect alternation. And I think that commodities are in the early stages of a secular bull, meaning 10, 15-year bull market, where commodities will more than double, go up, 250% or so, right? And that lasts for a long time. Now, I think, my guess is it's not until the oil makes a sustained breakout to all-time highs that we're going to start seeing equities completely unravel. So it's tied to the macro. Now, the problem with that argument is this would be one of the shortest secular bull markets in the history, at least of the U.S. markets. Right. I think COVID screwed up all cycles. It compressed everything. It just screwed up the market, economic cycle, and the equity market cycle. So I think being able to do those historical duration and magnitude studies are going to be thrown off a bit.
Yeah, I mean, at very least, COVID showed us that anything's possible, right?
Right. So let me show you another chart, Patrick. I didn't mean to cut you off here, but check this out. So let's talk a little bit more about whether or not this is a bull or bear market. And a classic indicator would be, the percentage of stocks that are overbought or oversold. And into the August low, the market was oversold enough, considering if we were still in a bull market, right? So classic technical analysis tells us what? It tells us that in bull markets, oversolds are short and shallow. So a good example will be what happened in 21, benign pullbacks to very shallow oversold conditions. Look at the bear market from 22, very deep oversold conditions. Now back into the bull market, this is about where the market should be oversold enough, at least internally. But
for that indicator, you're looking at RSI, is that right?
Correct. Basically. So counting how many stocks from a bottom-up standpoint are overbought or oversold on an RSI basis. So
I see.
we're here now, Patrick. What we're trying to do is we're trying to figure out if not just the character of the market is changing, but the character of the indicators that we track are also changing.
Wow. And in terms of sectors or industry groups, what are you watching in particular right now?
Okay, so for industry groups, what we're watching right now are those bellwethers, right? So I'm a big proponent of tracking bellwethers. So right now, home builders and semis would be two key ones to watch. Home builders obviously tied to the economy, but also very sensitive to interest rates. But also they have been leadership despite all this macro nonsense, right? And if you pull up a chart of ITB, very classic head and shoulder pattern, right? And as of today, they already broke support, and it looks as though they're headed to their 200-day moving average. Same with semiconductors, right? Tied to the economy, very cyclical in nature. They're breaking support, and it looks as though they're going to at least make a check to the 200-day, if not maybe undercut it. So those bellwether areas are concerning, but still, the most I can count them lower at this point is to their 200 days. I can't really count them much further than that yet. We really would need to see, Patrick, is the pullback to the 200-day and then see how that recovery takes shape. Do they fail at resistance to put in this proper series of low lows and lower highs? So bellwethers would be, or groups would be, home builders and semis. And then, of course, small caps.
Yep, they just can't seem to stand up.
No.
And how many times can we test this 1700 level in the Russell 2000? I mean, it seems like we've tested it numerous times successfully, but how much longer can that last for?
Yeah, well, I honestly, this picture that I brought with us today, it just shows a very classic, again, head and shoulders pattern, right? When head and shoulders is a silly name, but really what it's really telling us is that there's distribution, right? That there's a supply ahead in the market. A longer term picture of small caps really just show it in a tight range. Small caps are a disaster. It really speaks to the market of stocks not really being as strong. What do I think? I think after today's break and the momentum that we're seeing to the downside, you're still stuck in this range, and now small caps are going to be forced to come further down into their trading range. I guess next support is somewhere around 173, but I think there's probably scope for the IWM to get down to about 165.
Yeah, and that level dates back, 5 years or so. Very crucial long-term level.
Totally does. And if I may, Patrick, is to kind of talk a little bit more, if we can, about what the bleep is wrong with the bulk of the U.S. market. And a lot of ink has been spilled this year on breadth. And the chart that I brought today shows that the S&P has a clean series of higher highs, right? We can see that. You don't need to be a CMT to know that. But then the average stock, the equal weighted S&P, never broke out, okay? What really strikes me is that the advanced decline line for the Russell 3000 has been putting a series of lower lows and lower highs. Big divergence right there. So what does that ultimately mean to us, right? Well, it ultimately means that it depends on what your benchmark is. So if we actually were to look at the advanced decline lines for the three market caps, large, mid, and small, we can now decompose what the problem really is, or what the bleep is really wrong with this market. So for the Russell large caps, the advanced decline line is fine. Higher highs and higher lows. It really replicates what the index looks like. The mid caps, I would argue that the mid cap advanced decline line is stronger than what the index is showing. Mid caps never made a higher high in July, but the advanced decline line did. But then take your eye over to the right side of this chart, where small caps have been in their range, more like a coil, if you will, but the advanced decline line is at a new low. And this is where the bulk of the market is having problems with the Russell 2000 small caps. There's a lot of regional banks in there, a lot of biotechs in there that are trying to cure cancer, and they're just not going to, and they're just going to disappear. So that's kind of like, that's the issue. The issue isn't, it's just mega caps that are doing well. Mid caps are doing fine. It's just the small caps, but we can't ignore that. We can't just dismiss it and say, hey, who cares about small caps? There is a macro implication as to why that is happening.
And I love that chart there. It's a very good illustration of, I mean, your point's basically the whole bad breadth thing. Small caps is the culprit.
It is the culprit. And again, if you're a portfolio, most of my clients are portfolio managers and trying to construct portfolios, their benchmark is here in the large caps. They have opportunity, but where are they going to get their alpha? Where are they going to beat their peers? Is they kind of have to cheat a little bit and look elsewhere. And the elsewhere is not as strong. And if they go towards small caps, they've been getting slapped on the wrist quite hard. But what changes that is ultimately, I think, what we need to, kind of figure out and decompose.
You have this great chart of the dollar here, and obviously that's been a key part of the puzzle. Here it is working on its 10th straight week higher. Like I said, week isn't quite over yet, but it's pretty much flat on the week. And it's, flirting with 52-week highs there. And we're seeing it put pressure on stocks again.
Yeah.
So are you leaning bullish or bearish on the dollar?
Okay, so where am I leaning on it? So as of right now, I'm still leaning longer term bearish on the dollar. The recent strength that we're seeing in the dollar is interrupting that move. And as we speak right now, the dollar is bumping up against some important resistance levels. So the chart that I brought will kind of illustrate that. On the right-hand side of the screen shows the peak in the dollar, which occurred back in September. And if you remember back in San Francisco, when we both presented a year ago, I was like, the dollar's poised to peak. And how did I get there around 114? Over the years, I've kind of just started to use a little bit of the Elliott wave. And I've noticed that some asset classes respond to it better than others. And I would tell you the currency markets definitely do. And almost to the T, like 114 was what was projected, basically where it got. And then from there, the dollar started to react impulsively to the downside. So how do bear markets behave? They behave in waves of three, ABC declines. So what the dollar did from September to about March of this year was what is classically known as the A decline, right? The initial move. First impulsive wave low, gets super oversold. Then it needs to consolidate and catch its breath. And that's essentially what's been going on since March. But this rally on the dollar, so really this rally on the dollar hasn't been unexpected. What has been unexpected is that it's supposed to start failing right around here, around a 106 level on the DXY. And failure to do that means a couple of things, right? One is that perhaps July was the low in the dollar and that this ABC was very short and truncated and up and away we go. Or two is that it's just going to need to retrace a little bit further, maybe to the 110 level. So you asked me if I'm bullish or bearish on the dollar. I'm still longer term bearish on the dollar, thinking 95-ish or so. But from a tactical standpoint, there really isn't much sign of a top yet, which is where the upper left-hand chart shows that you really need to see the dollar start to break down. I would say somewhere underneath the 104.5 level to say, all right, counter trend rally is over. Things are going to be all right.
Interesting. So you still think it has a chance of rolling over? Is there a level, maybe like 106? I know you were watching 105, but
yeah,
like would 106 make you kind of reconsider? Or
yeah, that's right. So the major resistance level is 106. It's the March high, essentially, right? So you just kind of pull up a chart of the dollar, DXY. It's the March high. And why is that important? Because now you start changing the progression of lower highs and lower lows. Now you have that new high in there, and you have to start thinking about, all right, is this going to just go to 110 and then roll over, or forget it, we're going to 120 on it. And in terms of support, it's like 104.5. That would have to break on the downside to start thinking, all right, the dollar has peaked, and that should then start to act as a tailwind for risk assets. And again, let's just tie it back to small caps real quick. There is an inverse relationship between the dollar and the relative performance of small caps to large caps. So long as the dollar remains strong, small caps are going to suffer. Breadth is going to suffer. The average stock is going to suffer. So, and that is kind of where we are right now. So it's all tied to the macro and of course tied to interest rates.
That's a fascinating chart. I've never thought to kind of make that jump, make that link between, first of all, breadth being bad, and then it somehow being related to the dollar because breadth is bad because of small caps, and small cap relative strength is tied to the dollar.
So Patrick, think about it, right? It's like we've had free money for such a long time, and the interest rates have been so low that why not go to the casino and buy these really small, rinky-dinky small caps? You're just taking the punch bowl away, right? You're taking the punch bowl away from it, and it's going to start distorting how folks are approaching the small cap arena. I think we'd say another way to think about it is, it's very cliche to say this is going to be a stock picker's market. Well, if you're a good stock picker, if you are, this is your moment to shine. This is your moment to shine, all right? Assuming that you are good at picking stocks.
Yeah, and I wanted to ask you about that inverse correlation between the dollar and stocks. It's been in place for over a year now, at least, but historically, it hasn't been at least this, negatively correlated.
Right.
Do you think there's a chance that correlation just breaks down and really stumps people, or do you think that there's a good chance that that's just going to remain the case for at least the next few months?
Yeah, that's a tough question, right? Because correlations come and correlations go, right? So as of right now, that's been the relationship. So how I approach that question, and I think about it all the time, is the information content. We already know that there's an inverse relationship. The marginal piece of information that we can act on is when they start to diverge from its normal path. So it will change at some point. I'm not quite sure yet what will change that. The dollar historically is a safe haven asset, right? So we're in this moment of macros, everybody's freaking out about the macro. I could see the dollar be bid because of that. And that should be a headwind for stocks. At some point later on down the road, I think it's later on in when the economic cycle resets, I think that's when it'll happen. But again, I'm more concerned about when that starts to happen, and then we'll learn about it. But I think that's down the road.
Yeah, and let's move on to rates real quick, because obviously that's the big story of the week. You have almost every part of the curve hitting a multi-year high, but it seems like the dollar and rates are kind of moving together right now. Is there anything driving that relationship, maybe?
Well, yeah, a lot of it has to do with interest rate differentials, flight to safety towards the dollar. That would be the primary thing. But from a technical perspective, are we surprised that interest rates are moving higher? So I brought a chart that goes back to 2020, which I would argue, again, when I talk secular trends, that was the secular low in rates or the secular peak in bond prices, right? So higher for much longer, actually much, much longer is the motto that we should be embracing. I think what happened in the marketplace as of late, we've got complacent about the direction of interest rates, because really for a year interest rates went where? Nowhere. They went sideways. And if you just look at a sideways trading range and trend is already positive, the benefit of the doubt should be given to what? The breakout, right? And that's essentially what's happening right now. So the 10-year, I use that. Others may use other parts of the curve. Where are we in that uptrend? So just to borrow lightly on the Elliott, we are in what is known as the fifth wave of at least this up part of the uptrend for interest rates. The question is it going to be a truncated fifth, meaning a false breakout maybe gets to like 5% and then comes in? Or does it actually do what its measured move is and gets us north of 6% before it rolls over? That is up. That is yet to be seen or to know. But again, we shouldn't be surprised that interest rates move higher. What we should be surprised about is the impulsive nature in which it broke out and how it's weighing on stocks.
Yeah, and let me ask you, like, if I had told you that dollar would be flirting with 52-week highs and working on its 10th straight week higher, and rates were breaking out to our highest in a decade, would you have expected stocks to be under more pressure, or do you think they're holding up pretty well?
They've been holding up pretty well until today, which is September 21st, right? So today today was the first real distribution day since February. All right, so we've had pullbacks all year, but February was really the first pullback. of the year there was distribution. What's distribution? Lopsided breadth, lopsided downside volume, low percentage of stock, all that stuff, right? So we finally have distribution. So up until today, the decline was mostly benign. Like it really was like, oh, whatever. It's par for the course. It's seasonal weakness. Okay, working off overbought conditions and overly bullish sentiment. But this is where the rubber meets the road. Is that the S&P is now going to come down and likely test this 4,300 level, if not undercutting it to 4265, which is about what the 200-day is. But right. I think interest rates, right? The 10-year, just kind of look at this. You can look at the real 10-year, real yield as well. The short-term count is to about 4.5 to like 465, maybe even 470. That needs to stop. We need to see that selling exhaustion within treasuries take hold. And until that happens and the dollar starts to roll over, I think you have to at least remain guarded and treat the pullback in stocks as a genuine, corrective decline. But is it the start of a proper bear market? Too soon to know. And I think that's really going to be, again, known from the next oversold rally and see how that reacts. Does it fail at resistance levels?
I see. And, you mentioned that it might be a fifth wave, right? And aren't fifth waves often kind of the craziest ones or most energetic?
Yeah, they can be. I have a couple of clients who actually just trade fifth waves. They just go nuts on them. And you think about the psychology about that is everyone is already bullish. Everyone's waiting for the top and then it never happens. And then it forces everybody in, right? It's like, what's the most powerful pattern out there? It's the failed head and shoulders, right? Like everyone sees it. Everyone sees this head and shoulders right now in the S&P. Everybody does see it. My mom saw it. Okay?
And the Russell.
It's there. No, we don't necessarily dismiss it because it is telling us that there is some sort of transition or a moderating uptrend for sure. But, is it going to be the end of days? That is yet to be seen. But from a sentiment standpoint, even from DeMark at the CMT conference, the symposium, when Tom DeMark was up there, they got the Lifetime Achievement Award thing. What did he say? The most powerful DeMark signals, the ones that ignore the 13 cells, right? It's the same thing.
Those failures,
right? And as a trend follower, that's what we want. So how else to say it is kind of borrow George Soros's line is you want to be a bubble chaser. That's what you want to do. You want to chase bubbles. And that's how you really generate, I would say, substantial gains in your portfolio is just leaning into areas where you have conviction and knock on wood, that thing just keeps going and going and going. But to your point about interest rates, if we're in the fifth wave, that's kind of just the opposite. Let's bring it back to the macro. Yeah, this thing could extend. It could really extend. And some of my macro peers are quite upset about what Jay Powell said yesterday, thinking that, they're about ready to put us into a lot of pain.
I mean, he's been saying it, right? He's been telling us all along. A lot of folks just don't want to believe him, right? I guess, right?
Yeah, it's kind of true. Nobody wants to listen. The equity market has been addicted to stimulus for about 15, 16 years or so. You're taking it away from them and they're going to go through a tantrum. They're going to go through the shakes and all that. Yeah. And I think we're going through that. But it should be normal, right? Nobody in this business has been in an environment of rising rates and rising stocks for a prolonged period of time. You have to go back to the 40s and 50s for that to happen. Stocks went up in tandem. We're kind of in that transition, but it's a multi-year transition. And in the meantime, it's going to be a lot of wobbles on the way there.
Yeah, and John, I got to give you credit for not being shy about talking about Elliott Wave because, it's one of those things where when I was studying for my CMT, I kind of poo-pooed Elliott Wave. I didn't really put a lot of weight in it, didn't think I'd ever use it. But I'm really glad I had to learn about it because, I'm seeing a lot of smart people like yourself use it. And also, I do think there is truth behind the general idea of it and the whole idea where you have the early adopters or the insiders on that first wave, and then you have profit taking, and then you have the institutions driving that second wave, then you have profit taking. and then you have the public, and that's that crazy fifth wave that you were just mentioning, right?
That's absolutely right. Don't get me wrong. I've been doing this a long time, 25 years, right? And I remember when I first started, what I did was when I first got a Bloomberg, I put every single indicator on the chart, right? Like every single one. Like, look at me, I have, I'm a technician, right? Now I really just have like price and moving average and maybe a MACD, an MACD in there. But over the years, what I've noticed is that just like any other part of the investment process, even fundamentals, it's a mosaic, right? You want to use as many tools as you can to kind of come up with a clearer picture of where you think things are going to go. So I am full-blown trend follower, right? Mm-hmm. But with the Elliott, though, what it helps me is two things. One, it kind of tells me where I might be in the trend. Is it an early stage uptrend or mature uptrend? Okay, that's number one. Number two, Elliott discipline forces you to have that alternative scenario, right? So my base case for the S&P is we're going to go to 4,800 by year end, maybe a little soon after. Okay, that's my base case, right?
And that's basically all-time highs, right?
It's going to test the all-time highs. That's kind of it. So roughly speaking, test all-time highs. Okay, that's roughly it, right? But the alternative is that no, we're actually in wave one, and I put those levels in my chart regularly and saying, hey, look, this is where the scenario breaks down. This is where I'm wrong. So a trend follower what is a trend follower supposed to do? Always have a stop loss, right? I'm a publishing analyst. I have stop losses on my call. And for months now, my stop loss was 4,300, okay? And if we get only 4,300, then I'll start following my alternative path to the market, which would be I'll start increasing the odds. I wouldn't say it's highest odds, but I start thinking about maybe we need to see the S&P test the October lows. And that would really, blow everybody's mind, but it could happen.
Yeah, absolutely. And, if we did go back up to 4,800 and test those all-time highs, I can't imagine what sentiment would be like then. I got to imagine there'd be a lot of froth, and I find it hard to believe that we would just break right through on that initial test of the all-time highs. I could see a little bit of funny business happening around there. But I do want to move on to commodities. Sure. You started off with your whole thesis with this awesome chart of the Dow Jones and what is that, the Bloomberg Commodity Index, or?
It's a commodity composite. It goes back to 1900. So the earlier part of the data is really CRB, and the rest is just indices, piecemeal together over time.
I see. So tell us what's going on here again.
All right. So this chart goes back to 1900. So this is just good history, right? We need to, we need to learn from history. So basically the punchline is that stocks and commodities have opposite secular trends. So these are generational trends. So if you take your eye over to the leftmost part of the screen, you'll see that commodities were in an uptrend in the early 1900s, where stocks were still in their secular bear market. Once commodities peaked, all right, and declined, that set the stage for the go-go 20s. Okay, then what occurred after that, we all know the Great Depression, the crash of 29, and then commodities ripped during most of that bear market. Commodities went into their bear market from the 50s into the 70s, and that was when stocks were enjoying that beautiful secular uptrend. Then during the 70s, you could see now that during the 70s, there was a secular bear market and commodities were ripping. And I can just so on and so forth, we can repeat it. So I think, like I mentioned earlier, that I do believe that there was a secular low created in commodities in March 2020. I mean, negative oil, how is that not the low, right? How does that not?
I'll never forget that day. That was a weird day. I remember getting a notification on my phone that said CME Group will allow futures to trade negative. I was like, that can happen?
It's ridiculous, right? So how is that not like a generational low? But two, if you take your eyeball and you look at this, there are cycle studies. So even at that time, I was writing to clients, be prepared, didn't know COVID was going to do that. But I was like, hey, we're getting pretty darn close to a low in commodities, okay? So it is possible until we see a sustained breakout to new highs in the S&P 500, hey, this could be very early stages of a prolonged bear market for stocks. And if I could just transition it to oil, is that oil broke out smartly above that 75 area back in July. But a longer term picture of it said that shouldn't have broken down below 65. And that was the COVID, that was the kind of the COVID levels right there, right? And again, from Elliott standpoint, it was almost perfect decline. This is where it was supposed to bottom. And I wrote that declines. This is where we should start looking for it to bottom. And it did. It started to build impulse. And that's key. It's not just a benign move. It's actually a strong and powerful advance. My guess is, or my call is, that we should see a period of consolidation of sort, maybe to the low 80s, which would be totally normal, on its way up to at least 100. That's key resistance, but likely much, much higher. Think about sentiment and how things will turn on a dime when oil is sustained above 100. That's a psychological level. I think that'll be enough to freak folks out quite a bit. But put a 150 handle on it and think about what that's going to do. And if you go back and take a look at what happened in 2007, that's when oil went parabolic and it completely destroyed the equity bull market at that time. So I'm not saying it's necessarily going to happen, but again, this is the things I worry about as my alternative scenario. And oil is just as good as any example that could be the trigger for that.
Yeah, I mean, largely when we're talking about commodities, oil is a huge, huge part of it. You know, a lot of these commodity indexes, oil's a major portion of them. But, you know, you're just starting to hear about this commodity super cycle again for the first time in like a year. We heard about it a lot in the first half of 2022. But then once oil peaked around, what was it, September of last year? Or I'm sorry, June, right? June of 2022. Once it peaked, you really didn't, you really stopped hearing about that whole commodity super cycle thesis. And then it seems like these last 2 weeks, you're starting to hear about it a lot again. Right. So I'm just wondering what you think about that in terms of, you know, is that kind of getting too far ahead of the trend, or just kind of taking things?
No. I think your question kind of leads into studying the previous chart, which showed the opposite secular trends. It is early stages, right? The commodity index is not making and has yet to make an all-time high. So it is still early stages to think about that, sure. But you do your work, you do your bottom-up work, and you start looking at, hey, the structure of gold, which should be bottoming soonish. That also put a massive bottom in it was, I think, 2015, right? And that was projected nicely. And really the last year or so for gold is a bullish consolidation that should resolve higher and get us to like 2,500 or so in the next year and a half, right? So it's building towards that. And until that changes, then I think you have to keep this in your back pocket and be very, very mindful of that commodity super cycle. And it's there. Copper, you put in a nice bottom. Also, agricultural commodities, the DBA ETF, look at that. That has been very, very strong. So it's not just oil, right? So the breadth of commodities has improved. So if you want to talk about breadth, yeah, even it's not just oil, right? There are other things out there, other commodities out there that are bubbling and just kind of getting ready to start moving. And I would say one thing on gold. I had this question earlier today. But what about gold? It hasn't really done much. Aren't real rates going to screw with it? Real rates are going to rip. Gold should go down. I go, yeah. But what if we have a proper risk off? If you have a proper risk off, dollar rally with gold, and that scenario builds quite strongly once if and when the S&P starts playing with its 200-day, right? So it's getting underneath it, right? Once trend starts breaking, et cetera, et cetera. So you can't just say, oh, real rates higher, gold down. Don't forget, gold is also a safe haven. People just panic and they just go, I'm buying gold. And that could very well happen. And gold, what happens during bear markets? Gold outperforms stocks. So that trend isn't really in place right now. But again, that'll be the next thing to look at and put that in your toolbox. What is the relative performance trend of gold versus stocks? And I'll kind of leave it at that.
Yeah, I mean, it hasn't really done much, but at the same time, it hasn't really broken down decisively either. It's that massive base is still intact, and the breakout still could totally happen. You don't hear too many people too bold about that call anymore, because it's just been, it's like boy who cried wolf is how I like to describe it. It's every time we get up there, we've had like 3 rejections in the past 3 years or so.
Yeah, the other thing I remember, Patrick, is that price creates the narrative, right? So
absolutely,
there eventually will come around to it. they'll come around to it, and that's kind of our job as technicians to kind of listen to what the market's message is, and then assign a probability of whether or not, said message is going to continue or not. So I think that in time nobody was bullish on oil at 65, right? Now everywhere you go, everyone's an energy bull. Everyone. Okay. Why? Because people feel comfortable buying into strength. They like to follow the trend. They want to be a part of the crowd. They want to be left alone. They just kind of confirmation bias and all that sort of stuff, right? It makes sense. It makes sense to do that. But they'll come around even more on those other narratives once price confirms.
Yeah. So, we got to wrap it up. But before you go, a lot of these trends seem either in wait and see mode or pretty bearish. Are there any areas out there that you do find attractive right now that you would maybe hide out in, or that you see momentum in?
So a couple areas that would be interesting, that are interesting to me. As the market's pulling back, there's a couple ways you can approach this, right? I'm in the camp that this is a corrective decline to the 200-day moving average. Until that's done, you're going to hide a little bit in your lower beta stocks, maybe your defensive healthcare names. Those would be pretty good. I like kind of barbelling my portfolio that way. I'm a big proponent of like a core satellite approach where you're long, your long-term winners, but then you have these chart diversifiers around them. So I like having some of those defensive names in there. Like defensive healthcare, there's parts of food products and staples that look all right to kind of pad your portfolio there. But that should be centered around the core leadership within industrials and tech and parts of discretionary. Staying away from small caps, as we just talked about ad nauseum before. Not quite there yet. Trades, yes. Rentals, for sure. Once the market decides to puke and rally, they'll do fantastically well. The initial move off the low. I'm just not sure if they're going to be long-term winners. Elsewhere, I think Europe is very blah, right? Not quite. There's nothing really going on there for me to really get too excited about. The banks there.
You had European luxury stocks for a while, like the LVMH and Ferrari and a few other big ones.
But that first one you mentioned, right? That first one you mentioned was leadership, and then what did it do? It created a massive top pattern and broke down, right? So that's kind of like correct. That's kind of done, right? So Europe is kind of blah. Europe being blah is also very kind of light cycle sort of stuff, right? So I kind of push Europe to the side outside of energy and parts of industrials. You kind of go that way, right? To where else in developed markets do I like? And it's Japan. And what's interesting about Japan is that it's working in US dollar terms and in local currency, right? Local terms looks great. So if you can hedge your currency exposure for Japan, I like it. A little frothy now, thinking to pull back, blah, 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 but good structure there. And what's neat about Japan is that it's giving you value exposure. Japan is a value index, essentially. And you're not getting value exposure anywhere else, right? I like it from that regard. Again,
and why is that? What are some of those value areas?
Oh, the banks. Their banks have been like gangbusters, and in a way, it's a double-edged sword here when it comes to Japan. If you actually flip through the Japanese stocks and look at the market, it's some of them are straight up. You always would think like, wow, is this Pets.com from '99? I mean, they're almost like going a little bit too steep. But
and John, like I've actually looked at a couple of those Japanese banks in the last week or so, and obviously, just about anywhere else you look in the equity market this past week or two, it's been under pressure. But those Japanese banks, they haven't quit. They're still moving higher.
Yeah, and again, I don't know the why. It's not my gig to know the why. So that's
not our job, right?
Yeah, so that's one area that to at least keep your eye on, and you can maybe on pullbacks, allocate towards. So that's number one there. I would also, with the need, now let's talk about emerging markets. Emerging markets might be bottoming, but again, I think it's very blah in aggregate, right? And that's being kind of pushed from weakness in China. So mainland China is a disaster. You want to talk about bad breath? Mainland China is terrible. It's always in a perpetual decline and an advanced decline line. Like, don't touch mainland. But like the K-Webs, the mega caps, they you take a step back, they do look head and shoulder bottoming, but they haven't bottomed. So if something's bottoming, doesn't mean they bottomed. But where is their strength? South Korea, India, mid-cap India. Mid-cap India has a lot of AI exposure.
Interesting.
I like that area if you want to go outside the US and play a little EM. But basically, when I think about EM, it's EMX China. So if I'm right about energy, then therefore Latin America, so commodity exporters should do well on a relative basis. So LATAM relative to EM Asia should outperform. So I would be looking at those stocks as potential diversifiers, or if you're overseas investors, I would look over there.
Yeah, that one ETF, I think it's, what is it, EMXC, emerging markets excluding China.
Yes,
I know that's been getting a lot of attention, and
that's right.
It's because China is just a huge weight on EM, and EM has been kind of a boy who cried wolf chart too, right? I mean, you've seen numerous attempts to turn, but every time it just gets smacked down, it seems like.
That's right. It's the we'll eventually get through this equity malaise, and perhaps emerging markets will be the first ones to tell us, because they were the first ones into the bear market in 21. In my math, if I did that right, yeah, in 21 they were early.
That's right.
They were early. I think they were like peaking in May, April-ish, right?
Right. Like K-Web, right?
Right, well before the S&P peaked at the end of the year, right? So I kind of believe in the idea of first in, first out. So the first ones into the bear market should be the first ones out of the bear market. And EM has yet to break out, very similar to small caps, right? So it's that part of the risk curve has yet to confirm what we're seeing within the U.S. markets. And perhaps the U.S. market is just the most defensive area to be. And then maybe, yeah, I don't know. I don't want to talk much into a bear. But like you can kind of see where that is, right? Like you need to see absolutely. Global breadth as well. And where's the global breadth besides like Japan ripping?
It was kind of there in the first half of the year, but it really hasn't followed through.
So close.
So close. Well, John, I think we probably got to leave it here. I could pick your brain for hours, but you've given us a lot of food for thought. So we'll sit here and digest it. But thank you again for coming on, and I hope you come back soon.
My pleasure, Patrick. Thanks.
Cheers. Have a great weekend. Thank you guys for watching. If you enjoyed the show, be sure to click like and subscribe, and we'll see you again next week. Thanks.